Okay, we're going to finish up our discussion of stocks by looking at some of what I call the all-stars of investing. Because I believe if you want to learn how to do something well, learn from those who do it well. And here are some of the best investors of the last 100 years. The first one is Peter Lynch. He was the mutual fund manager of the mutual fund Fidelity Magellan. Now, Fidelity is the name of the company, and Magellan was their fund. As was usual of Fidelity at the time, the mutual fund managers were basically thrown into the milieu, into the environment, and basically said, "Go get it, guys! Go gals! Go do your best job." And you would think a mutual fund named Magellan would be, because Magellan was the explorer that went around the world, would be a global fund. No, it was mostly United States-based companies. But it turned out that the capital appreciation category that it was in, which meant go ahead and make money any way you want, and we'll discuss that in Chapter 13, suited Mr. Lynch very well. He is very eclectic, which means he's good at everything. You know, he's very, very good. He picks from everybody. He doesn't specialize, and he's just had a very good eye for seeing unrealized value, as we discussed back in Chapter 11. He says, buy what you know. Don't buy the latest gee whiz bang computer, social networking, nanotechnology, whatever company, especially if you don't understand the technology, because everybody else is buying it. Don't do that. If you wear Nike shoes, maybe you should buy Nike stock. Now, he doesn't say you should do that. He's just saying that you understand that they sell shoes, or if you own a Toyota or a Ford or whatever, and you're happy with the product, go look up the company. Maybe it's a good investment. Maybe it's not. But that's where you start. And he was very good at buying what he knew. We discussed his book, One Up on Wall Street, where he posits this theory, where he expounds and recommends this theory. So do read it. It's a great book. He's got a great sense of humor, real dry. Warren Buffett we've already talked about Mr. Buffett. He tells people, don't buy a stock, buy a company. He puts emphasis on the value of the entire company. In other words, if you would want to own FedEx or whatever company you're interested in, if you would want to own that entire company, if you'd want to have it yours, great. Go out and buy 10 shares. All right? And now, obviously, how many people are going to buy the entire company? He does. He's gotten so big that he goes out and he buys the entire company and takes it private. Just a few years ago, they bought his company, Berkshire Hathaway, bought Burlington Northern Railroad. Yeah, right. They bought the whole railroad. They own Geico. They own Dairy Queen. And they used to own the Washington Post, but I think they sold it. Benjamin Graham. Benjamin Graham was Warren Buffett's teacher, and he's often called the father of value investing. He wrote The Intelligent Investor, and that's a book you're going to want to eventually read if you're going to make your own investment decisions. You must read that book. Take Business 123 too. Okay. And then John Templeton, Sir John Templeton, pretty good for a guy from Tennessee. One of the first mutual fund managers to invest globally. And we'll take a look at some quotes from these gentlemen here. And then slide 49, Bill Miller. This is an example of how the industry can pick you up and elevate you to the pinnacle of success and then throw you down and spit you out. It's a rough business, folks. Poor Bill Miller. Do you feel sorry for Bill? I don't feel too sorry for Bill Miller, but here's what he was. He was the fund manager of the Legg Mason Value Trust. And we'll come back and take a look at this in Chapter 13. It's a mutual fund. Legg Mason is the name of the company. They're based in Baltimore, and Value Trust is the name of the mutual fund that he ran. And for 15 calendar years in a row, he beat the Standard & Poor's 500. Unprecedented record. You know, this is the kind of danger that the industry has. He became, unfortunately for him, as far as I'm concerned, the financial media's megastar. Every word he said was analyzed and parsed and dissected. Can you imagine trying to do your job with a 10,000 watt spotlight shining in your face or over your shoulder? It would drive me insane. Well, he did it by being very concentrated. His portfolio was much smaller in terms of the number of stocks he held than most mutual funds. And that works great if you pick the right stocks, but if you don't, right. He then lagged badly in 2006, 7, and 8 during the financial turmoil and really just did really poorly. He seemed to redeem himself in 2009 when he was up over 40%, beating the 26% return of the S&P 500 in 2009, but then again trailed badly in 2011 and 2010 and 2011, and he retired in late 2012. Now, I was surprised that they let him stay as long as he did because, folks, it's a tough business. I can imagine there's a whole lot of Xanax and Maalox and Tums that are sold in that business because, oh boy. Now, what do all these people have in common? Slide number 50. They have courage to not follow the crowd because the conventional wisdom, I didn't mean to say the unconventional wisdom, the conventional wisdom is usually not very wise. If everybody's running one way, do you want to run that way? Well, maybe, but usually in the financial world, no. And they have what I call the eye for unrecognized value. Think of it like a sixth sense. They sense something that many other people ignore. Garry Kasparov was once asked why he and Anatoly Karpov were the two best chess players in the world. Now, you probably don't know who these gentlemen were, but in the late 80s and 90s, into the 90s, they were the two best chess players in the world, and one would win the world championship, and the other one would win it, and they were going back and forth. Eventually, Kasparov became the undisputed champion, and he went on to play a computer, which isn't really fair because as soon as he beats the computer, they change the program so he can't beat it the way they beat it again, and he eventually lost. His answer was astonishingly simple and direct. We attack better than anybody else, and we defend better than anybody else. Right? How do you argue with that? Right? Can you throw a fastball at 90 miles an hour, 95, 98 miles an hour? Can you hit a fastball at 98 miles an hour? These investors bought the best companies and avoided the worst companies. So again, I use a sports analogy. I don't know if it works for you. I'm not a big sports fan, so don't think I am. But there's offense, which people tend to be really enamored with, and then there's defense. And defense, in my humble opinion, is a whole lot more important than the offense. But there are others who think differently. Either way, you've got to be good at buying good companies and avoiding bad companies. Speaking of avoidance, on slide 51, as a mutual fund investor, which I mostly am, I am not looking to find the next Peter Lynch. No. I'm looking to avoid the next Charles Steadman. Huh? Who's Charles Steadman? Well, he ran his own mutual fund, the Steadman American Industry Fund. That's not a very good idea to name it after yourself, but that's what he did. From December 1959 until his death in late 1997, his cumulative total return during one of the largest increase of the global economy in the history of the world was minus 42.9%. He would have done much better simply placing his investors' funds into a savings account at a bank. He actually would have done better putting it in a mattress. I don't know, maybe he came from the life insurance industry. So you see, you understand? You don't need to find the next Peter Lynch or Warren Buffett. I mean, do look for good managers, but you want to avoid people who are really bad because it turns out you don't have to be a Peter Lynch or a Warren Buffett to be successful in investing. It certainly helps. But, I mean, who needs their own private jet? I certainly don't. Slide number 52. Let's hear what these gentlemen have to say. Warren Buffett says, "Be fearful when others are greedy. Be greedy when others are fearful." You understand? When everybody's running this way, rich, 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 we're going to be rich. That's the time when you say, oh, I don't know. I think I might go the other way. And then when everybody's running away, oh, stocks are crashing. Run, run for the hills. That's the time to be greedy. His mentor, Benjamin Graham, said it this way: buy when most people, including experts, are overly pessimistic, and sell when they are actively optimistic. That's from The Intelligent Investor. And did Mr. Buffett follow his advice and the advice of his mentor? You bet he did. In 2008, when the organic matter hit the ventilating device and stocks were falling like crazy, he rushed in and he bought $5 billion of GE and $5 billion of Goldman Sachs. Now, they were in need of cash. They were hurting for cash, and he didn't buy the shares that you and I buy. He bought special shares that gave him a sweetheart of a deal. And that's what it pays to be rich when it comes to investing in that case. But you see, and he wrote an op-ed piece, opinion piece in the New York Times saying, look, we're going to survive this. I'm investing in America. I have faith in America. It turned out he was right. It turned out both were very, very good moves. Slide number 53, John Templeton. Bear markets are born of pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy. Now, I added the emphasis. I made it bold. But that's the case. When everybody else is going, oh, the world's going to end, that's when you should buy. There's an old saying, buy when there's blood in the streets. Well, that's a little extreme, I think, but that's the idea. On a similar note, he also said, to buy when others are despondently selling and sell when others are avidly buying requires the greatest fortitude and pays the greatest reward. Now, did Sir John Templeton follow his own advice? Oh, yes, he did. It's December 1941. You history buffs know what that meant. The United States had been sitting on the sidelines. The public was not eager to get into World War II. The FDR, Franklin Delano Roosevelt's administration was, because they saw what was happening, and they because the United States had been basically snookered into World War I, and it extended the war another 6 months or so. At least that's what the consensus is. I'm not a historian, folks. But this time it was different. It was very different, and FDR was, by many accounts, trying to get the United States in on the side of the Allies. It goes into the Japan. We were pushing Japan, and the Nazi Germany had signed an agreement with Japan, so that if they got into if we got into war with them, they would declare war on us. Germany would declare war on the United States. And some people were saying that the United States basically go to Japan and do attacking. There's no real proof, but it sure looked that way. And they did not, I don't think they thought that they would attack Pearl Harbor. They thought maybe the Philippines, maybe Alaska, which, by the way, wasn't a state. Neither was Hawaii at that time. And sure enough, the Japanese said, all right, we'll we'll play your little game. And 1/3 of the Pacific Fleet disappeared on one day. It doesn't look good for the Allies. Meanwhile, Nazi Germany is in the Soviet Union, and they're falling apart. So it didn't look good. What did Sir John Templeton do? He tells his broker to buy every bankrupt company on the New York Stock Exchange. The free world is about to fall apart, and this guy's going out and buying every bankrupt company? 4 years later, the war is over. Mr. John, he wasn't a sir yet, but John Templeton is a very wealthy man. Would you have that kind of fortitude? I don't know. I don't know if I would. Slide number 54. Famous myths and stupid sayings. These are things you're going to hear people say, folks. Just nod your head and smile. It can't go any lower. Oh, yes, it can. It can go to zero. Once it goes to zero, it can't go any lower. And you'll talk about companies that, used to be huge conglomerates and they were on top of the world, and then whatever, for technological reasons or just bad business decision, or somebody else came along and ate their lunch, they're going out of business and the stock has fallen precipitously, but it can still fall lower until it hits zero. It can't go any higher. Oh, yes, it can. This is what people would say about Philip Morris and Procter & Gamble and these companies that have been around forever, and they kept going higher and higher and higher. If the earnings are continuing to grow, there is no limit to how high the price can go. It's only $3 a share. What can I lose? $3, right. Forget the price. Look at the capitalization, the valuation. It has to come back. Oh, yeah? You ever hear of Penn Central? Or Braniff Airlines? You probably have never heard of Braniff Airlines. Maybe you've heard of Pan Am or TWA. How about Kodak or Polaroid? Yeah, some companies don't come back. Slide number 55. When it rebounds to $10, I will sell. Now, I understand what's going on here. They bought it at 10. It's now at 6 or 4 or 5. And we are humans. We do not want to admit that we made a mistake. So they're waiting for it to go back to $10 so they can sell it and say, I didn't make a mistake. But if you would not buy the stock at the price it is right now, it's time to sell. Plus, we humans are wired to forget the stupid things that we do and painful experiences. So if you sell it, you'll quickly forget and go on to the next one. But if you hold on to it, stubbornly waiting for it to rebound to where you bought it, every time you look at the screen or your statement, you're going to be reminded of how stupid you were. So my advice, sell it, take your loss, find something that excites you now. The stock's gone up, I must be a genius. The stock's gone down, I must be an idiot. No, the stock doesn't know you own it. I love some people, they'll say, I'm such a bad stock picker, I'm going to blackmail a company. I'm going to say, if you don't pay me money, I'm going to buy your stock and it's going to fall like a stone. There's an old saying, never mistake a bull market for brains. In fact, when the market's down is one of the best times to get started, when it's a tough market, because it makes you feel human. You will hear investors who say, I started right when the market, 1962 or 1982, when the market just went straight up, and I felt invincible. What a bad deal that was. Exactly, because then, right, they weren't prepared for the downturns. And you'll hear people who say, "Well, I got in at 72 or 87 or 2000," and it turns out that was a good deal for them because they learned that it's not all sweetness and light. It's taking too long. Well, folks, unless you're one of these very, very lucky people who happens to be working with a company that's just going public, it's going to take a long time. It doesn't happen overnight. It's a marathon, not a sprint. Or at least for the vast majority of us, it should be. If you want to be a stock trader, buy and sell and buy and sell, and try to make eye-popping returns, I wish you the best of luck. I cannot help you. I can't do it. I'm not even going to try. So it's going to take a long time. But the cool thing about that is it gives you a chance to buy more. If it zooms up, oh well, now it's too expensive. Patience is an investor's most important trait, in my humble opinion. Slide 56. It's different this time. Well, yeah, it's different every time. Every day is a new day. But that does not mean you should not pay close attention to the realistic future prospects for the earnings of a company, whether good or bad. It's a new era. It's a permanent trend. Wait a minute. A permanent trend? That's Andrew Tobias. I love that quote. It's a permanent trend. Ain't no such thing. Markets move in cycles. By the way, permanent trend is like, it's like jumbo shrimp. straight curve. It's an oxymoron, heavy on the moron. And some people are going to say stocks are too risky. They're going to say, oh, I don't know. You invest in stocks? I don't invest in stocks. Stocks are too risky. Well, you have to acknowledge their fear because they're right. They are risky. They're going to go down. And people know that I'm heavily invested and I teach this stuff. And when the market tanks, they'll go, oh, aren't you upset? I say, yeah, not really. I got a long way. I'm not going to touch it anytime soon. In 2008 and 9, they would say, oh, what are you doing? Haven't you run yet? I said, no, I'm just doing the same thing I do all the time. In fact, I put a little bit more than I usually put in. I said, I'm not happy about a 40%, 50% decline, no, but I felt really sorry for the real estate investors who saw their entire investment destroyed. They lost all their money, and then some of them were sitting on they were holding houses that were $100,000, $200,000 less, worth $200,000 less than what they still owed on the house. Talk about that, losing money, borrowed money. That's what a kicker that is. So stocks are risky, yeah, but not all. The other investments can be even riskier, and we'll get to that when we talk about real estate as an investment after mutual funds. Slide 57. How about a career in stocks? Huh, folks? How about a career? Would you be interested in a career in stocks? Well, if you are, the good place to start would be hint, again, Business 123, Introduction to Investments. But the term that we use is stockbroker, but the real legal term is registered representative. That's the legal term. It's also called a financial representative, an account executive. Some people call them financial planners. There's going to be a background check. They're going to want to look into your background, make sure there's no shenanigans with other people's money. They love ex-military because ex-military military people were in a very structured environment. They love women and bilingual. They need more bilingual. They need more women. And it turns out a lot of brokers are retiring now, so they're looking to sell their business, and you can then you have to build your own business at the same time, but you could buy somebody else's business. Yes, you have to take 2 tests. The first test is called the Series 7, and it's pretty tough, folks. It's not impossible. Many people flunk it the first time because they don't take it seriously. You have to study at least, in my humble opinion, 2 months, an hour a day, 1 to 2 hours a day. You really, and I stupidly got rid of my flashcards. I cannot believe I did that. I just, threw them away I was so relieved, and I should have kept them. But once you've taken the Series 7, then you've done the hard part. It's 6 hours, 3 hours in the morning, an hour for lunch, and 3 hours in the afternoon. So it's a serious test. The Series 66 is an hour. It takes a couple of weeks to study. It's not hard. You must be sponsored by a brokerage firm. Some brokerage firms would exist to simply sponsor people, but that's not true anymore. Many of the brokerage firms are now recruiting new recruits, new people, and we've had students who've just had the Business 123 class, and then this class too, and then they spiffy up their resume. Not a single typographical error. Get some good clothing, hide the tattoos or whatever, and get in there and make your best pitch, and they will hire you as a broker's aide, a broker's assistant, or some other clerical position where you can't fly solo, you can't make recommendations to people, with an eye toward making you a registered representative. I love it. I really enjoy it. And even though I say nasty things about them, brokers and life insurance agents and bankers, the financial world is very rewarding, in my humble opinion, because you're helping people meet their financial goals. I mean, that's a great feeling, especially when I see people who would never have saved a dime, now putting $50 or $100 into a Roth IRA, and then 5-10 years later they say, I think I want to buy a house. Well, you can raid your retirement account for a house. That's a good reason to raid your retirement account. Don't raid it for a trip to Tahiti. Okay? All right. So last slide here, slide 58, swapping some horror stories. This is in the face-to-face. We try to see if anybody's who has bought stocks can talk about their war stories. And these are companies that I bought that didn't turn out the way I thought they would turn out. And each and every one of them was a very good company, folks. Don't get me wrong. Their products or their technologies were awesome, but for some other reason, things just did not turn out well. You know, for something in three of them beyond their control. One of them, there was some hanky-panky going on. Let's talk about that one. CNR Films. This was my Peter Lynch stock. For 20 years, until over 20 years, yeah, it was over 20 years. Sesame Street was the most popular children's show on PBS. And then along comes a show called Arnold. Wait, no, not Arnold. What's it called? The little mouse. You know, the aardvark. Oh, I can't remember his name now. Not Arnold. That's Arnold Schwarzenegger. But it escapes me now. I apologize. But it's adorable. You know, the aardvark and then his friends. One's a rabbit, Buster, and the monkey is a friend of his, and they're animals. But it was so well done. It just was so well done. And it was done by a company called CNR based in Montreal. The music and the stories, and my son was in 3rd grade, and that was their target market. So we would sit and watch Arnold, not Arnold. Yeah, okay, maybe it's right. I mean, it's Arnold. I can't remember what, but it's gonna come to me in 30 minutes. I apologize. But we would sit and watch that, and I looked at looked up the company CNR. They're publicly traded, okay, so you can buy into them. They're based in Montreal, and they are incredibly talented people. They have other programs that are doing very well. They've just signed signed with a worldwide agreement to distribute their content, their art, you know, their programming, using a small little electronics company you may have heard of from Japan called Sony, right? Owns Columbia Pictures, and so things are looking good for CNR. And the stock did well. I bought some shares, bought some more shares, and then one weekend, the Royal Canadian Mounted Police, that's the FBI in Canada, swooped into CNR's offices. Yeah, it turns out that in Canada they have a little bit of a inferiority feeling because the United States is so big, and they're right next door to the United States, so they often get overshadowed. So they will give you tax breaks if you hire Canadian artists, actors and graphic artists and musicians and the like. And what was going on at CNR? They were hiring American, United States actors and artists and people, and palming them off as Canadian citizens to get the tax breaks. All right, okay, so the stock drops in half, right, overnight. Okay, so pay a fine, get over it, you know, your company's still in good shape. Then about 3 weeks later, it was revealed that $130 million was missing from CNR's balance sheet and had been spirited away to the Bermuda Islands, and the stock dropped again in half, and then it turns out that CNR is insolvent, and all the programming is sold to at a fraction of the cost to a competitor in Canada, because Canada doesn't want to lose the company itself. They don't want to lose that. See, this doesn't happen when you buy a Coca-Cola or a McDonald's, or when you buy a small company. Any one of many things unrelated to the actual business can knock the company for a loop. Cardiodynamics was another example of that. They make they're not public anymore, somebody bought them, but they make a phenomenal type of device that detects the blood flow through the heart. And before this technology was available, with people who had serious heart disease, they would have to do what's called, let me see if I get this right, pulmonary arterial catheterization, which some people die just from the test, where they have to stick something down into your heart to measure the blood flow. These people do it almost like an EKG or an EEG, with measuring the electrical impulses, and it works. And in fact, it worked too well. It was showing that there's a whole lot of people who have heart disease and need heart bypass surgery walking around, and they don't even know it. And so Medicare got spooked and said, we're no longer going to pay for the test anymore because we don't want all these people having heart surgery. And then the insurance company said, well, Medicare's not paying for it, we're not going to pay for it. And nothing to do with the viability of their product. You understand? It's something completely out of their control. And the stock dropped in half. And so that's the problem with small companies. But I kept, these were the companies that were in my Las Vegas fund, my Vegas fund. Small companies based, three out of the four were based in San Diego. I looked up what was going on. CNR was Montreal, but the other three are San Diego. And sure enough, folks, you can have the best technology or really cool product and be knocked down by something completely unrelated. Advanced tissue, what a cool technology. This stuff is real artificial tissue. And Alliance Pharmaceutical makes artificial blood. And both fell apart. The companies, not the technology. Somebody else is going to wind up with the technology. This is typical with small companies. Slide number 59, the bottom line. Stocks are the best long-term financial investment available, folks. Trust me, they really are. As long as you have a long-term perspective, you will do well, unless the world falls apart and then all bets are off. But then it doesn't matter where you put your money. Leave the stock picking to the pros, folks. For the vast majority of us, find a good stock mutual fund, which, by the way, is the topic of Chapter 13, our next chapter. As bullish as I might appear to be, my wife and I have 99% of our stock investments through high-quality mutual funds. I simply believe it is unrealistic to think that I can do better than professionals armed with an entire global research organization at their disposal. I stopped trying as my Vegas fund lived down to its name. I now call it my Benjamin Graham fund. How's that? Yeah. And every time I followed Mr. Graham's advice, I did well, and every time I didn't follow his advice, I didn't do so well. Oh, I did it at first, I did. But he says it very succinctly. These are speculations. These are gambles. And you could do well, and you can not do well. And he was right. And that, dear students, is our discussion of stocks. What do you think? Excited? Well, and scared at the same time, okay? I hope so, because it is difficult. That doesn't mean you shouldn't do it. And if you do want to do it, take Business 123. But we're going to now move to the investment that is for the vast majority of us, investments for the masses, mutual fund. So we will now tie things together, because bonds are cool, but they're kind of boring, and we don't really buy them ourselves because they want you to pony up $25,000, and stocks are cool, but boy, you can lose a lot of money, so it's hard to get diversified, and you got to be on top of these things, and you might not enjoy it. So when we get into Chapter 13, we'll find that, hey, somebody else will do it for us. For a fee. See you in Chapter 13. I remember what the name of the show is. This is Arthur. I'm sure many of you with kids out there are yelling at me, Arthur, it's named Arthur. And of course, CNR blew up 10 years ago. Or when did it blow up? Actually, not quite. But Arthur's still the most popular, if not the most, very, very close, most popular show on PBS for kids. And so it shows you that sometimes the product and the company, the product at least lives on, the investors in the company disappear, and it reemerges as something else. So it's Arthur. And they also do Caillou, and they did Whimsy's House, and they did a few other The Big Comfy Couch, and a few other very popular kids shows. And they really are, they were good people, except for the people who ran the place, who got into serious trouble. And I don't know if they ever did jail time in Canada, but okay.